Welcome back and thanks for being with us. Let me bring on board Kunal Botra, as he always does every afternoon. Kunal, great having you. We missed you in the morning, Kunal, but give us your call with regard to the Nifty. What's the sense like and what is it that you're seeing? In fact, while we speak, Kunal, Brent is at $115 a barrel. Huge risk likely.
Yeah, good afternoon, Harsh. I think, yes, that's the biggest risk. And that's why I think in the last half an hour or so, you saw the banking index suddenly taking a U-turn. I think we've retraced some 300 or 400 points on the bank Nifty on the back of this either sudden spike or the surge in crude oil prices. But it's also, I think, to say that the trajectory for crude oil prices over the last few days has been on the upside. But our markets have been a little bit more resilient, if I can use that word. Per se. So that tells you that maybe I think our markets are expecting or anticipating that we might probably be looking at crude oil prices just hovering around this 110 plus minus $5-7 per barrel mark over the near term. I think with this intraday price movement, we are still trading above the key support levels. We were highlighting 24,000 on the Nifty, for example, as a strong support zone. We are still trading above those key support levels for the Nifty. So till the time the index movement is above those key support levels, the bias on the index remains on the bullish side.
Okay. Okay. So as long as those support levels remain, bias remains on the bullish side. Abhay, hi, great having you. I'll come to you in just a minute. Let me just quickly close this with Kunal. Kunal, therefore, what's the sector bias looking like?
So in terms of sector bias, I think today you're seeing some fresh names popping out in terms of breakout. The mid cap and the private sector banking names, the likes of Bandhan Bank, RBL Bank, etc. So that's one sector which I would believe traders could look at. I think even the IT space, and I think many of these IT stocks are now starting to look a little bit more attractive. There is almost 3 or 4 consecutive days of strong price action in the mid cap IT space as well as the large cap IT stocks. That's another sector which I think could come back into traders' radar.
Stock bias, Kunal?
So two buy calls, Harsh. The first one is about MCX, something which I recommended even yesterday with a target of 3,000 yesterday. But today, I think after this 2.5-3% up move, would revise the targets higher to 3,100. So traders who are looking at a fresh buy could consider the stock at the current juncture. Buy with a target of 3,100, stop us at 2880. And the second would be a bond DMart. Now, after quite some time, the stock is coming back into a flag pattern breakout about the 4,600, 4,650 mark. So would suggest a target of 4,800 for DMart, stop loss to be kept at 4,500.
Okay, Kunal, we'll give this part of the conversation a pause. Let me go across to Abhay Agarwal, who's joining us. Piper Serica needs no introduction. Abhay, great having you. Let me start off by asking you what you're doing in a market like this. It's so volatile.
Yeah, Harsh, good afternoon. Nice to talk to you again. We're not doing anything extraordinary. I think we are, as a growth-oriented fund management house, we are always looking for interesting opportunities. And I think the results season that we are going through is giving some interesting pointers to us, some of the investment theses that we had built, for instance, in pharmaceutical space, in smaller banks and NBFCs, seems to be playing out, even FMCG, some of the large names. So we are always looking for, building conviction in new opportunities that are on the track. Not really worried about the market volatility, Harsh, because, none of us can do anything about that. A lot of it is sentiment driven, and that sentiment changes by the hour, by the tweet, I would rather say. So no point fighting that volatility. All we can do is use that volatility to our advantage whenever it gives us good entry points.
While we're speaking, Abhay, we're seeing a bit of a crack on the market itself. The Nifty Bank has cracked quite a bit. Now we're flatlining on that count, and that's because of crude. Abhay, that's the big concern, right? The uncertainty leading to the spike in crude oil and what that is doing to both Indian economy as well as markets, therefore. You believe that this is temporary, and the fact that probably, and one of the probable factors that may help that thesis is the fact that UAE has come out of the OPEC plus. You believe that this crude spike to 100, sustainable, temporary? What's your take?
No, I think whatever I've seen and read about it, Harsh, I think it looks highly temporary to me. We have seen such spikes earlier. We have seen lows, where crude traded at a negative price, -$5 during COVID season, because COVID time rather, when there were no takers for crude. And now, a couple of years back, again, we had seen spikes above $100. But Harsh, there is an auto balancing mechanism also in the system. It's a global commodity which is of a very high importance to both the sellers and buyers of crude. So it is in nobody's interest, frankly, at the end of the day, to have very high volatility in crude prices. Right now, what we are seeing is market sentiments driven by the Hormuz Strait closure rather than anything else. And I think even with OPEC coming out, UAE coming, Saudi Arabia coming out of the OPEC, it hasn't made a dent right now because everybody is focused on the Hormuz closure and the supply through that. I think this is a situation which will resolve itself. Frankly, my guess is maybe 7 days, 10 days, and my view is that once the crude supply comes on track, we will see crude prices going back to $60-$70 where they have been for a long time. So I'm not at all worried, I think, but in the short term, of course, market is right in worrying about a potential spike and what will it do, the damage it may do in the short term. But beyond that, I don't think this is going to be a major red zone or red signal for the markets.
And what's the likely knock-on effect to earnings? Because we haven't yet seen prices at the pump really change, and therefore you're not seeing the full translation or the full impact of this even yet, and we may not see it for another month maybe.
Yeah, so I think you're absolutely right. I think none of us really have felt, the industry hasn't felt, other than the aviation industry where the jet fuel prices have gone up, but none of us have really felt it because despite the crude prices going from $60 to $100 plus, none of us have experienced any, we're not paying any more at the petrol pumps. So if this situation sustains, and I think in a month or so, when the government is able to raise the prices, it probably will. And I think that is when, it may have a potential impact on inflation. But as I said, also, the whole economics changes, Harsh, because right now, for example, the electric vehicle buyers, both four-wheelers and two-wheelers, and even larger vehicles, commercial vehicles, which are driven by electricity, they are running their decisions on buying a IC engine or an EV on the basis of current petrol and diesel prices. But if these prices go up, what will happen is that a higher number of electric vehicles will sell. So the demand will anyway stay, come down probably. So that is where the auto balancing mechanism also comes up. It's not that the demand for crude and oil and petrol will be the same at all price points. As the price increases, the demand comes down. So I think that is what will happen. But in the short term, the oil derivative consumer companies may have some margin impact. But I think the kind of demand environment we are, Harsh, I think they will be able to pass on most of it to customers.
Right. That kind of sets us up beautifully for this conversation. Therefore, the environment has changed substantially over the last couple of months, right? And therefore, as would be understandable, the sector preference, the tilt, the kind of earnings growth that you start to pencil in from certain sectors versus others may also have changed. Give us a sense as to, over the last month or two, what is it, in your opinion, that has changed in terms of a bias for a sector? Is power, energy more a play, a larger play now?
No, look, in a growing economy that is attempting to grow at 9-10% annually, power will drive, and power in all forms, whether it is fossil fuel or whether it is electric vehicles, renewables, that is very important for the economy's growth. So I think backing power companies, power generators, transmission, all the players in the entire value chain is an opportunity for investors. Of course, with the caveat that there are times when these sectors get overpriced because of the sudden fancy of investors. So barring that overvaluation risk, I think any company that is in the power and energy space will do well for next 10 years. They will see an earning pickup, and as long as they manage their capex and financials properly, I think there is a very long runway. But valuation will be important. If investors pay too much right now for these companies, then they will have suboptimal returns even after the company is doing well. In terms of other sectors, I think our conviction has gone up in pharma, and pharma, large generics, definitely, but even the new innovation companies that have built, specializations across different therapeutic segments. I think they have done a lot of good work in last 5 years and are now breaking out at a global level in an environment where the world wants to buy specialized medicines from non-Chinese vendors. So we are seeing a lot of traction there. And I think some of the results have also been good. I think Sun Pharma doing such a big acquisition also gives us faith that these companies are using their cash flows to grow internationally now. The second space is the whole electronics manufacturing, contract manufacturing, EMS place. And that has expanded significantly with multiple players doing multiple things. They are not doing commodity stuff anymore. So margins are going up, demand is going up. So EMS and pharma and also small banks and NBFCs is a third space that we have seen very good results and backing that uprun in that. So these are the three sectors I would say, Harsh, that we are very, very bullish on based on the recent results.
Take that one sector at a time. So with regard to pharma, there's obviously one argument which says that India isn't doing enough in the biosimilars space, for example. Would that be an apprehension for you, and therefore would the picks be more bottom up and the stories be more bottom up?
Yeah, I think biosimilars is a very, very expensive, capex heavy, long gestation, long R&D budget business. So I am not expecting, frankly, any big outcomes for biosimilar companies from India. I think where we can benefit from biosimilar is that if we get contract development or contract research opportunities from international biosimilar companies to farm out work to us, which is high margin business. I frankly don't expect our industry to come up with new biosimilar drugs in therapeutic segments. But there is an opportunity to do CDMO, and I think some of the companies are jumping on that. Generics is going to be a big play always, especially niche generics. And, so I think there are plenty of opportunities for the pharma space and pharma for exports, also healthcare domestically, hospitals, diagnostics will continue to be a big play. So I think overall that space is ripe for, pretty solid outperformance.
Okay. And Abhay, with regard to manufacturing, have you been using the dip to buy EMS stocks, or even now do they look ripe? Because we did see quite a largish correction in some of those names, but we've seen a bounce back also, which has been equally strong.
Yeah. Yeah, so this is the classic early growth segment, I would say, Harsh, because these are companies which are not very old companies. If you look at them, they are probably 15, 20-year-old at best. And now is the time that in a very positive environment, they are growing rapidly. The biggest benefit that we are seeing them have access to is the whole move towards manufacturing in India, the sovereignty stack that the Prime Minister also talks about nowadays. That in a situation where there is either because of geopolitical risk or for any other reason, we have a supply chain shock. And, we are not able to get simple electronics from China or other countries, or, battery assembly for EVs or sensors which go into all the cars nowadays. We recently banned Chinese cameras for surveillance. They are banned across the country now. But somebody has to make them in India. It's not, somebody has to develop the sensor, the chips that go inside them. So I think that will create a very positive environment for these EMS companies. Many of them are catering to defense requirements now as far as active components are concerned. So I think these are young companies. That's why the price has been volatile. But as the earnings grow and as they become from small cap to mid cap and to large cap, you will see lesser price volatility. But this is a time to buy them. Frankly, I think with the assumption that, look, these stock prices till these become large caps will be volatile, but probably a 3-year journey. If you can live through that volatility, I think leadership positions have been already taken by 4 or 5 companies in the EMS space, and they will continue to grow. So that's our view. We are happy to, in our model portfolio, we have 4 EMS companies for last 4 years, and we continue to add to them.
Interesting. Abhay, sorry, last quick question. I really need to take a break, but I'm going to squeeze this in anyway. Give us a sense with regard to earnings risk. How large is the earnings risk if for example, and this is for the market at large, how large is the earnings risk given the kind of uncertainty that's playing out in West Asia?
Yeah, I think I see an earnings risk for the large caps that are too dependent on raw material prices, low on innovation, especially IT services companies, large private sector banks. I see an earning risk. But the companies which are in the mid and small cap, I think they will benefit from any disruption because they are high on the innovation curve. So I am expecting that the mid and small cap earnings will grow faster than large caps over the next couple of years.
Okay. Abhay, thank you so much. This gives us a good lens into how you're looking at markets and what kind of action you're taking in terms of direction, sectors, etc.
Thank you.
Okay, and viewers, what we'll do is slip into a very short break, continue coverage, stay with us here. We'll start talking stocks on the other side of this break.